Think of this agenda as your ultimate exam prep checklist for today. First, the partner admission scenario. Second, steps for standard revaluation. Third, allocating revaluation profits. Fourth, the memorandum revaluation approach. And finally, number 5, exam scenario, which method?
Section 1, the partner admission scenario. Okay, let's dive right into this and set the stage for the exact kind of context you're going to see on your test.
Imagine you're sitting in the exam room, right? And you get hit with this classic scenario. A new partner is admitted into a partnership, maybe to increase capital, maybe to strengthen management. Now, the firm's assets have gone up in value over the years. So the big, high-stakes question is, does this new partner get a share of that past asset appreciation?
The answer is a resounding no way. When a new partner joins, it's absolutely crucial to bring all appreciation or even reductions in the value of assets into the accounts right on the date of admission. Why? Well, we have to update the balance sheet. We need to ensure that all those profits that accrued and all the losses that occurred before the new partner arrived are brought into the books. This guarantees that the old partners get exactly what they earned before the new person even stepped through the door. Section 2, steps for standard revaluation. Let's look at the foundational knowledge, the typical default exam scenario you'll run into. To actually do this, we open a very specific account. It's defined as the revaluation account. Now, pay close attention here, because examiners love to test your terminology. This is also known as the profit and loss adjustment account. Actually, scratch that. It's not just also known as. It's literally the exact same thing. If you see either of these names on your test, they mean an account open to record the revaluation of assets and the reassessment of liabilities. If you step back and look at the whole partner admission process, it's kind of like a giant puzzle. Revaluing assets and liabilities is just one piece. It sits right alongside other critical adjustments, like adjusting goodwill among the old partners in their sacrificing ratio and transferring existing reserves to the old partners' capital accounts. The whole shebang is just one big process to clean up the books for the new partner. So, what is the exact sequential accounting logic for the journal entries? It's honestly pretty straightforward once you get the rhythm. Step 1, you debit the revaluation account with all the reductions in the value of assets and increases in liabilities, essentially your losses. Step 2, you credit the account with increases in the value of assets and decreases in liabilities. Those are your gains. Step 3, you just find the difference between the two sides of the account, and boom, that shows you the net profit or loss on revaluation. Section 3, allocating revaluation profits. All right, this brings us to the most critical area where students always seem to lose points, the allocation. You need a totally foolproof mental framework for this. So here are your golden rules for standard revaluation. First, the profit or loss belongs exclusively to the old partners. Second, it is distributed strictly in the old profit-sharing ratio. Third, once those entries are done, any subsequent profits or losses going forward will automatically be shared by all partners, including the incoming one. Seriously, just repeat this in your head. Standard revaluation equals old partners, old ratio. You will not go wrong. Now, what's really interesting is seeing this rule perfectly executed. Imagine a revaluation account showing a total net profit of $30,000. That profit, it doesn't touch the new partner. It's split specifically between the old partners. Let's say they're Gopal and Govind. Gopal gets $18,000 and Govind gets $12,000, which reflects their old 60-40 ratio. That is the standard method in full action. Section 4, the memorandum revaluation approach. Okay, this is the climax of our study guide. This is the trickier, higher-level exam curveball you've got to watch out for. You're cruising through your exam, you see a partner admission question, you're feeling good, but then you spot a very specific phrase. The prompt specifies that all partners agree to keep the assets and liabilities at their old values, even though they agree to revalue them. Wait, what? How can you revalue something but keep it at the old value? It sounds crazy, right? This is the ultimate exception to the rule. When you see this curveball, you absolutely must use a memorandum revaluation account. By definition, this is an alternative account divided into two distinct parts. It's used exclusively when the partners agree that revalued figures will not be shown in the balance sheet. So under this specific approach, the book values of the assets and liabilities literally do not change at all. To pull this off, the account is split right down the middle into two parts. In part 1, you record the revaluation of assets and liabilities normally, just like we did earlier. The resulting profit or loss from this first part goes to the capital accounts of the old partners only, in their old ratio. But here is the magic trick for part 2. To complete the double entry and keep those asset values totally unchanged in the balance sheet, you completely reverse the entries you just made in Part 1. Then, you transfer the resulting balance of the second part to all the partners, including the new one, in their new profit-sharing ratio. Section 5, Exam Scenario. Which method? Let's bring it all together to test your knowledge and make sure you're absolutely ready for test day. So the crucial point here is understanding the direct contrast between these two methods side by side. A standard revaluation account, it's got one part. The book values change in the new balance sheet, and the balance goes to old partners in the old ratio. A memorandum revaluation account, that's got two parts. The book values remain unchanged, and it needs two transfers. Part 1 to old partners in the old ratio, and Part 2 to all partners in the new ratio. Let's treat this like a mini case study to practice decoding the exam prompt wording. If the prompt simply says revalue assets and reassess liabilities, easy. You use the standard revaluation account, old partners, old ratio. But if the prompt uses phrases like values of assets and liabilities remain the same, or book values should not change, that is your trigger. You must use the memorandum revaluation account and apply that two-part allocation rule. All right, I'm going to leave you with one final provocative thought to really test your mastery of this logic. If you are doing a memorandum revaluation account and Part 1 shows a profit, what must Part 2 show? Think about it, because Part 2 is an exact reversal to keep those book values unchanged. If Part 1 is a profit, Part 2 must show a loss of the exact same amount. If you genuinely understand that dynamic, you have mastered the underlying logic of asset revaluation, and you are entirely ready to ace this section of your exam. Good luck studying.